So I'm here with Lori Hoberman, the head of emerging companies and venture capital at Chadbourne and Park. And she's just come from our Finance Your Dream, Finance Your Business panel. And Lori, welcome. I'm so glad to have this opportunity to chat with you.
Thanks, Carla. It's great to be here. Great company.
Thank you. So on the panel today, we were talking about women and them not taking the opportunity to go after venture capital. And I've read a statistic, the number one reason why women-owned businesses do not succeed is because they get to a point where they need more capital. Can you talk about how and when you might make the transition to going after outside capital?
I think there's an inflection point in a business where you reach that point where you can't bootstrap and grow any further. And once you're at that point, it's a signal that if you do want to continue to build the business and grow, you need to go out and fundraise. And I think that fundraise takes many forms, as you heard from the panel. And women in particular need to feel personally comfortable with how they fundraise and who's investing money into their companies. And I feel I see in my practice that women sometimes do not take in enough money to really effectively grow their companies.
So can you talk a little bit about that? How they can make the decision to...
Sure. From a business standpoint, it's good to look at your expenses carefully and get a sense of what you're going to need to get yourself through the next 12 to 18 months of business. If you can finance it with organic growth, great. It means you don't need to go out and fundraise, and you can probably continue to build your business just the way you're doing it. But if you look at those expenses and you see that there's some point in time where you really run out of money and you can't continue to grow that, then you gotta go out and look for money. And a really good rule of thumb is don't give away the business on that first fundraiser. I advise people not to sell more than usually 1/3 of the company. And it's important to make sure that as a founder, you hold on to the equity, because the equity is the most valuable thing you can possibly have. And if you're selling that too fast, you kind of lose the incentive to keep building the business.
If you just had one piece of advice that you wanted to give a woman entrepreneur who feels that she is ready to go and find funding outside of her friends and family, outside of her own funding, like self-funding her business, what would you say to her?
Don't part with too much equity. Make sure that you are not being overly generous with the first person who writes your check. And make sure that you realize that you have to keep the equity for yourself as much as you possibly can, because you're going to be sharing that with your employees as well. So be cheap with the equity that you give away to investors.
On the flip side of that, what makes a company sexy for investors to invest in, whether they're friends and family? I mean, I guess there's probably a little bit of difference between friends and family and VCs and other investors, but if you could just talk about venture capitalists, angel investors, what makes a company sexy for them to, sexy enough for them to invest in?
4 points. And so, are you surprised?
I'm like, nice, 4 points. Let's go for them.
4 points. First, what is the problem in a given industry that the company is in? Mm-hmm. And what's the company's, second point, what's the company's solution to that problem? Third point, what's the market for that solution? You could have the greatest solution to a given problem, but if nobody will buy it, no one's going to invest in the company. And the fourth point is, how do you monetize that solution and how do you access that market? If you're able to answer all of those questions, what you're coming up with is what makes a company appealing to an investor. So solving a problem and having a market for that problem.
And in terms of being in business and showing any kind of success beforehand, I know that we talked about that.
Flaunt it.
Flaunt it. all that you can do, and you've done it successfully, but you need some support.
And if you've gotten it that far, what you've done is you've proven the model. You've proven there's a market out there for your product. And it's time to test the investor market and see whether the investors will bite.
Okay. So is there an average time frame for that?
For a fundraise, or from the time where you first come up with the idea till the time you get to that
For
point?
a fundraise. Like, how do you determine when it's time for you to fundraise? Is it at the beginning? Does it depend on the business?
It depends on the business. It depends on the entrepreneurs. I found that the entrepreneurs that come out of other companies, other early stage companies, they have accepted the fact that they're going to fundraise and they go out and do it right away.
Okay.
Entrepreneurs who are starting from scratch may not do it as quickly, and it might need to really dawn on them that they're at the point where it's a bottleneck, they can't grow anymore without other money coming in. So the amount of time to do a fundraise, it takes, I'd say, a solid 30 to 60 days to find a group of funds that are probably interested and to send your executive summary out to them. And then what you hope to get back are letters of intent or term sheets that, or at least at that point, invitations to come. Yeah, some indication of interest. Term sheets are way in advance. I'm wrong to say that. But what you want to get back are invitations to come talk to them. Once those invitations start coming in, it's usually about 90 to 180 days between that point until you actually close some money. There are many steps in the process.
All right. Well, I just wanted to get a feel for that because many women are, out there not thinking about this, and to just plant the seed in their head. When is the right time? Whether it's right at the beginning or whether it's sometime down the line when they've really built a name for themselves.
And that's what I typically advise. Wait until you've developed some value for the company before you go out and fundraise. Otherwise, even just to raise $500,000, you could be selling half of the business.
Well, thank you so much.
Thank you for having me. This was so great.
Good.
It was a lot of fun.
Oh, good. Thank you.
Thank you.